get some insights on news shaping the markets. For that, we welcome in Joe Brusuelas, Chief Economist at RSM. Thank you so much for being here. We've gotten in, obviously, more and more data. We have Jay Powell speaking for 2 days. Your thoughts on some of the recent numbers that we've been seeing and getting in?
Well, the economy looks pretty strong to me, right? I mean, I think we're clearly decelerating from that robust 3% plus growth rate we had last year, right? But we see it coming in, between 2.2 and 2.5% this year. We're tracking right at 2.2% right now in the first quarter. We're expecting tomorrow morning on Friday, see 180,000 increase in total employment. The unemployment rate right around 3.7%, and a nice 0.3% month-over-month increase in wages. So things continue to be very strong. When I see the markets today, we got nothing but green on the board here at the New York Stock Exchange, right? I think one of the things, Nicole, it's been about 30 years since we've seen productivity in the U.S. economy jump. We were stuck in that 1 to 1.5% range for a long time. And I think there's a lot of people out there in the market who've forgotten that improved productivity means improved profits. That, to me, is what's putting a floor really under this market. It's not just the Magnificent Seven. It's not just a flow of capital into AI, which, by the way, is a productivity play, right? But the idea that this is going to be spilling over into other areas of the economy. So I'm feeling pretty bullish right now in 2024.
Yeah, I mean, I was looking yesterday at a slew of names hitting 52-week highs in the last week or so that were not part of the Magnificent Seven. And it was really really broad-based across many different sectors, which obviously brings some reinsurance.
And what's really impressive is both in our own internal survey, where we have just under 50% who's increasing outlays on software, equipment, intellectual property. But when you look out over 6 months, it's almost 60% who are planning to increase outlays on productivity enhancing investment. That's really the genesis of something different. And that's just not our mid-sized firms. The Business Roundtable was out with their Q1 survey. They had a big jump year over year in plans to increase CapEx. When you get the combination of the real economy, those firms that we work with, and then the great big multinationals moving in the same direction, well, that train's left the station. I don't know about you, but I want to be on it, not in front of it.
I'm looking back at some of the other reports that came in. The ISM non-manufacturing came in, and JOLTS came in. That was a little change. You had jobless claims. We'll have the jobs report tomorrow, to which you said 180,000, which is a little bit lighter than some of the other estimates I've been hearing. Anything jump out at you and some of these other recent reports?
All right, so in the JOLTS data, let's have a little fun. You take a look at the quits rate, right? It's largely been very consistent, although much lower from the past couple years.
Yeah, 3.4 million. The layoffs, 1.6 million. So those haven't changed that much.
No, so if you take that quits rate, create a quarterly average and lay it on top of the employment cost index, now that's the wage variable that the Fed uses, and you project out 6 months, it's heading below 3%. Again, you see wages grow somewhere between 3 and 4, which is the sweet spot. That's going to provide lots of relief to firms out there who've been dealing with much higher wage increases year over year for the past 4 years. Again, what's going to happen? Equity valuations tend to look a lot more friendly under those conditions. Again, very good information. And then in terms of jobless claims this morning, 217,000. I'm old enough to remember us talking sometime before the pandemic. In the 10 years prior to the pandemic, jobless claims on a weekly basis averaged over 300,000. And we're at a 217,000 run rate right now. This is what full employment looks like. And again, it's been 30 years since we've had a real strong increase in productivity. Well, it's been over 50 years since we've been at full employment. These are new things. We're all learning or relearning some things about how the U.S. economy can work if you get the policy framework right and you get a little luck.
Were we not at full employment before the pandemic?
No, we were not.
Okay. Let's talk about, I had my question and then I started thinking about jobs overall. Inflation, I think that's another thing. You have us coming down, right? You said with the economy slowing, so that's a good sign. Housing, shelter is really a part of the PCE, but really it's everything else that the Fed is watching. That brings me to my question, which was you usually were leaning towards many cuts, weren't you?
Well, I had 4 cuts, and I still do. We haven't changed that
I knew
forecast.
I had my question in my brain because I was thinking how last time we spoke, in the last several times, you were thinking that the Fed was going to have to cut more than maybe some other people were thinking. Where do you stand now?
We're still at 4 cuts, and we're still at June. My forecast hasn't changed since last November when we first started really talking about what this year would look like. The economy does outperform. The likelihood is we're going to get 2 or 3 cuts, and the risk is not, it won't be June, it'll be July. But nevertheless, when you take a look at what Jay Powell said yesterday and today, very low bar for rate cuts. The idea that they think the policy rate's restrictive, they're implying that they're going to move to cut. Now, if I remember the turn of the year correctly, the market had priced in 7 cuts, right? So I was only at 4. I was the pessimist on that in that little particular game of expectations. But nevertheless, look, we get 3 rate cuts that are in the Fed's forecast this year. We're going to do very good. And here's the thing, everybody out there. Life does not revolve around the Federal Reserve. There are times when the real economy moves into a sweet spot and you do see productivity increase. That increase in productivity will drive profits, and it will drive valuations across asset classes in general and the equity market in particular. A lot of you out there just have not experienced this economy. I got to experience this 30 years ago. Good things happen when productivity takes off. And I think that's really one of the under-discussed narratives of early 2024.
I like it. I like it because productivity equals profits, and people will feel better. Thank you so much, Joe Brusuelas.
Anytime,
Great to see you of RSM. Thank you.